It's high time you stop feeling sorry for yourself whenever price doesn't get to your order block. Sometimes you see that you may have marked out a very valid order block. It has everything, it ticks all the boxes for a valid order block, but you see that price keeps snubbing your order block and taking off from other places but still in your direction. And then you begin to wonder, is it that my strategy has stopped working, or is it that the order block has stopped working, or is it that something else is the reason for your not being successful at this? Well, let me tell you something. Sometimes the market actually goes to deliver price to other institutional reference points, and if you are not aware of them, you keep on missing out on trades even though the price keeps moving in your direction, whether a buy or a sell. In this video, I'm going to be showing you a whole lot of other things that you do not know, specifically about other institutional reference points that market delivers price to instead of your order block. So if this is something you'd like to learn, then stay to the end of this video and do not miss any part. Let's get started. One thing a lot of ICT traders do not know is that order block is not the only place where the institutions like to trade off from. There are other institutional reference points, about 7 of them, and together they are known as the PD arrays. PD arrays simply means premium discount arrangements. A trader with a good knowledge of this PD array concept can be able to get trades that are not necessarily reaching their order block. So even if price doesn't reach your order block, if price gets to what we call the mitigation block, the breaker block, a liquidity void, or even a fair value gap, you get to key into these trades. Even if price never gets to your order block, you are still in the market. All right, you will see sometimes that you will be actively trading, you will always be in the market, but you keep missing trades because price never gets to your order block. But price gets to other levels, and those levels are what we call the PD arrays, right? So number one on the list, first and foremost, before we even go into them one by one, you need to understand what the PD arrays is. Okay, it is just a sequential arrangement of all other institutional reference points that the institutions are interested in taking their impulsive movement from. You know, when you look at your charts and you see those long candlesticks, they are often fueled by the institutions, right? And they take off from other price points that are not your order block. Okay, so it is an arrangement of different price points that the institutions like to put in their large orders. Okay, and it is arranged in a way of how frequent you see it, how frequent it plays out. Okay, so even if you have a situation where an order block doesn't play out, if you get a good understanding about PD arrays, other institutional reference points, you will be able to key into the market. So number one on the list, right? Number one on the list is the mitigation block. Okay, number one on the list is the mitigation block. It is quite simple to a mitigation block is usually in line with the trend. Okay, a mitigation block is usually in line with the trend. So sometimes you see that maybe, let's say price is in a downtrend, so let's say price is giving this sort of movement, right? And then it gives this very impulsive sell. Okay, and then you may be where you are and you are waiting for price to get to the order block that influence this break of structure, right? Which is how a lot of people look for. So let's say this is let's say this is here, and we have a very impulsive sell movement to the downside. While you are waiting for order block to come in, you may see that sometimes the price will just come back. Of course, you must have marked out your break of structure right here. Okay, so this is like a sell movement, and a lot of people, if they see this kind of thing, they are already waiting for a sell to take off from this order block. But you see that sometimes price will just come all the way from this place, come here, and instead of getting to this your order block, it will just come here, somewhere here, and then take off from there. Okay, I hope this is bold enough so that you can see. So this is what I mean. Okay, sometimes you'll be waiting for price to get to your order block, meanwhile price has actually seen a mitigation block somewhere here, and it usually happens when your order block is so far away from where price is at the moment, right? So price may not necessarily come back to your order block and react from there. Instead, it's going to go to the mitigation block and react from there. So you may be wondering, what is a mitigation block? So if you have a good understanding of how order blocks work, it will be very easy for you to spot a mitigation block. Now, of course, what we know about an order block, so let's say we are in a downtrend, right, and we are looking for a bearish order block. A bearish order block is simply that last buy candle, right? That last buy candle. Let's put this as green, because I know that that's what a lot of people use. Let's put this as green. So let's say this is a buy candle right before the sell candle that influenced that impulsive sell. Okay, so let's say we have another sell candle right here. So this is a sell candle, a buy candle, and then this one is a sell candle, and after that sell candle there was like a strong sell. There was a strong sell to the downside. Okay, and then for a mitigation block, so let's say that we have this price movement, price is in a sell. Okay, and you know, when you're looking for another block, we are actually looking for let's say we're looking for a bearish order block. It's just the last buy candle before the sell candle that influenced that impulsive break, right? Basic order block knowledge. Okay, so but in a mitigation block, when you see something like this, of course this is a buy candle that influenced this. If we are in a sell, then this is the last buy candle that influenced this corrective movement. Then after the corrective movement, we went for an impulsive movement again. Okay, so this is where our order block is, right? The last buy candle before the sell candle. Let me take that away. The last buy candle before this sell candle, right? The last buy candle that influenced the last sell before this impulsive leg. Okay, before this impulsive leg. Now, having established that, you can see that instead of price to come back, so now I'm just showing you the difference between an order block and a mitigation block. So ordinarily, those who are waiting for this order block, they are just waiting for price to come up to this point and then sell from there, right? But then you can see that there may be a bullish candle sitting right here just at the last swing. This is a lower low, right? Yes, the last lower low before the last lower high. The last lower low before the last lower high. There will be a bullish candle sitting right there, and then instead of price to get, especially when the impulsive move is so wide that it is so far from your order block, you tend to see sometimes that price, instead of getting to your order block, price will just come all the way to this point, get to this buy candle, right, at the lower low, at the swing low. This is the swing low, right? Because this is in a downtrend, so we have series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, right? So instead of us waiting for price to get to this order block, sometimes price will only come over to this last swing low, right? This lower low. If there's a bullish candle right there, it will just go there, pick it up from there, and then boom. Okay, gives us a sell movement right there. So this is a typical mitigation block. So instead of getting to, you will be waiting for price to get to your other block. Meanwhile, price has just used, the market has just used this mitigation block, especially when it has a liquidity around that area. It's just going to take off from there while you are still waiting for your other block to play out. Okay, so this is just like an example of a mitigation block. There are others. We have the breaker block. The breaker block is almost like the mitigation block, but in a breaker block is usually found when, you don't find it all the time though, but you usually find it when price is either moving from a buy side to a sell side, or from a sell side to a buy side, meaning Is it that price is moving from a buy trend to a sell trend, or from a sell trend to a buy trend? Okay, so this is like this mitigation. You usually find it when you have already established that price is in an existing trend. So if price is in a downtrend, if price is already in a downtrend, you can see this mitigation block. Is if price is in an uptrend, it can also give you the same price movement. So in that case, so let's say in a buy scenario, so instead of price to, so let's say price is doing something like this, instead of price to after price gives you this impulsive move, instead of it to come back to this place, to come back to this other block, it will just pick from this side and then boom. But we are already, it has already been established that price is in a, let me take this off. So price is already in an uptrend in this case. So instead of price to come back to this your other block right here, let me extend it. So instead of price to come back to this your other block that is sitting right here that you are waiting for, okay, price may just decide to snub you and then come and use this mitigation block right here. So that is basically it. But the most important thing about the mitigation block is that you are already in an existing trend. But in the case of a breaker block, price is actually trying to change that trend, right? So let's say this is we are actually coming from a downtrend, right? Let's say we are actually coming from, or let's use this example first. Let's use this example first. So let's say price is here. So in this case, let me take this away. So in this case, we are still talking about a downtrend and a breaker block in a downtrend. So this used to be a downtrend, right? Let me also take this away. This used to be a downtrend. So in a downtrend, we are not expecting that price will break these our highs, right? We just want price to keep on breaking our lows. Okay, so in this case, when price has done something like this, of course we'll be expecting that price will come here, from here, continue to give us something like this, and so on. Okay, so now a time will come that instead of price to break from this low and continue its movement, you see that price may just come here, from here, just take off, right? Just take off, come over to this place, right? And then start a buy movement. All right, so there would be a bullish candle sitting right here. Of course, there will be a bullish candle sitting right here at the end of this swing high. Let me make that a green candle. So there will be a bullish, of course, a bullish candlestick right there at the end of this swing high. And of course, we'll be waiting for price to come here and continue the movement. So instead of price to come here and give us another impulsive sell movement, it will take you out, all right? Take out this last swing high, right? Take it and then come back again and now use it. Instead of it to become a bullish, is a bearish leg, you will now see that price is using that same block and now turning it, is now flipping it from a sell movement to a buy movement. That's majorly the difference between a mitigation block and a breaker block, right? A mitigation block, of course, a mitigation block, you may see something, this is a mitigation block right here, but then price may get tired of selling, come here, and instead of it to come here to your other block, of course you would have marked here as your other block, expecting that price will come here and sell from there. Okay, you expect that price is coming to sell from there, but then price is not going to sell from there. It's just going to take you out, all right, give a buy movement, take you out completely, then come back there when it is coming back to that zone that you expected to be a bearish order block. It is going to come back there and use it as a bullish movement. right? It's going to use it as a bullish movement. And if you are aware, especially if price comes and gives you, don't worry, this is just like me using some drawings. We'll actually go into the chart. I'll make other videos so that you actually see this on the live chart. Even though the breaker block is quite difficult to see on the, it's rare to see on the chart, but when it appears, it's usually, especially when it comes with a liquidity, with any form of liquidity, is usually an A+ setup for me. It usually works for me. So of course you are required to go back and check all these things and actually see how they work for you in particular. Okay, so that is essentially what it is. Mitigation block is usually priced using an order block, right, or a swing low or a swing high, right? But then you know that yes, price is already in an existing downtrend or an existing uptrend. But in a breaker block case, price is actually flipping it from a buy movement to a sell movement, or from a sell movement to a buy movement. Okay, so that is just basically it. That is just basically it. You can see that price has changed trend. This used to be a downtrend, now it is an uptrend, right? So instead of price to come back, even if you spotted that price has, you see that some traders, even if you have spotted that price has taken off and broken this, you have confirmed a change of character right here, indicating that the trend wants to change. You see that some traders are actually waiting for price to come back to this other block that was created here. That price left when price gave this impulsive buy from here to here. So you see that a lot of people will be waiting for price to come to this other block right here, right? But you see that sometimes price may not get to come back and deliver price to you in your other block. Instead, it's going to use a breaker block right here. You can see how it turned that swing high, now made it a swing low, right? It now made it from a swing high to a, that's why it's called a flip zone. The market has made that your swing low, that your swing high rather, it has made it a swing low, right? That is going to fuel a buy movement. All right, so you can see that yes, if this were to be an order block movement, you'll be waiting for price to come down to this point. So sometimes price may not actually be interested in coming down to this point, especially if you use your Fibonacci tool and it has marked, like if the breaker block or the mitigation block is around your Fibonacci level 50%. Okay, if it is around your Fibonacci level 50%, price can actually get to that zone, completely ignore your order block, and then take off from there. What I mean by 50% retracement zone in your Fibonacci, of course, when you take your Fibonacci tool and mark it out from your swing high to your swing low. Let me take this off so that we don't get confused. So when you get here and you see that price has given a 50% retracement, the mitigation block or the other block is inside your 50% zone, right? It is way past equilibrium point. It is in your discount zone. Discount now because we are now talking about an uptrend, right? So in an uptrend, we are looking for discount zones to buy from. In a downtrend, we are looking for premium zones to sell from. So in this case, you can see that yes, the 50%, the mitigation block or the other or the breaker block is inside of your 50% zone. Okay, I have talked about premium and discount level in another video. If you have not watched that, I'll link it up here so that you go and get better knowledge of it, so that you understand what I just said about Fibonacci levels and all. Okay, so but if price has given us something like this, okay, if price has given us something like this, then there's no way it is not going to just continue. There's nothing stopping it. Actually, there's nothing stopping it from coming here, giving us a very good zone right here, changing this zone to a buy zone, to a support zone, and then continue to buy from there, right? That's basically everything about breaker block and mitigation block. It may seem confusing, but when you go over it, you can take this video backwards so that you can understand better. So you may not really understand it first, but when you go over it over and over again, it becomes very easy for you to understand. Next up, we have a liquidity void. A liquidity void is like when price aggressively delivers price without giving the other part of the market to any room to breathe. So you can sometimes you open your chart and you see where you have a lot of candlesticks, right? About 3 or 4 candlestick, impulsive large candlesticks that are of the same color, right? They are either very large buy candlesticks or very large sell candlesticks that are not even giving the other part of the market or the other end of the market any room to breathe. So you can come to the chart and you see a series of sell candles lined up like this. This is a liquidity void, right? This is a liquidity void. 3 or more candlesticks, you see that they are not even giving price any, they're not even giving the other end of the market to even make any struggle. You just see that price has aggressively delivered, the market has aggressively delivered price from one liquidity point to another. All right, so this is like, let's say we have, this is the sell, this is a sell candle, sorry, this is a sell candle, this is a sell candle, this is another sell candle, this is another sell candle, right? You just see that price just aggressively delivers, the market aggressively delivers price from one point to another without giving the other party or the other end of the market, the other side of the market. All right, in this case, price aggressively delivers price from one swing high to another swing low without actually giving the market. You just come on your chart and you just see a series of sell candles or a series of large candles. Very impulsive, especially when they have little or no wicks, right? When they have little or no wicks, you see that price has aggressively, the market has aggressively delivered price from one point to another. This is a liquidity void. Like I said, this video is just an overview. We would actually go into all of these institutional reference points one after the other, okay, one after the other, so that you get better understanding of them all. Okay, so this is just it, especially when they have little or no wicks, okay, and you see such aggressive movement, no fight back from the other end of the market, just series of long, very bearish candlestick or very bearish long bullish candlestick. That is a liquidity void. So you can see that from the PDRA that we talked about, we haven't even started talking about order block, your favorite order block, right? So you can see that there are other institutional reference points that the market makers or the market movers tend to be more interested in trading from than your order block. So it is wise that you actually know all of these things, so that even if price doesn't get to your order block, you would still be able to gain something from the market. All right, next up we have the fair value gap. Of course, a lot of people know the fair value gap. The fair value gap is almost like the liquidity void, but the only exception is that when we're talking about your fair value gap, right? So you can have a series of, you can have a candle like this. You can have, it's usually of, the formation is usually 3, right? 3 candlestick formation. The fair value gap is a 3 candlestick formation. Let me take this away. So even if they have candlestick, you see that you find 3 candlesticks and then there's a void between the first and the second, the first and the third rather, the first and the third. Now you mark from the end of the first one, right, to the low of the first one and the high of the first one, of the third one rather. The low of it is the space between the low of the first candle and the high of the third candle, right? So whatever space is in between here, you can see I'm marking from the wick now. I'm marking from the wick to the wick. Okay, so let me not fill this. Okay, so it is this space from the low of the last candle. So let's assume that this is even a buy movement, right? Let's assume that we have 3 candlesticks, 3 buy candlesticks, okay, even if they have wicks or not. So let's just focus on the 3 candlesticks, right? So let's say we have this, there are wicks right here, but then there's a space between the last candle, the high of the first candle, and the low of the last candle. right? The high of the first candle and the low, there's a space right here. This space is what we call the space between here, from here, the low of the first candle. You can see the low of the first candle, so I'm going to be marking that out, the low of the first candle and the high of the last candle there. All right, the low of the last the low of the first candle and the high of the last candle is what we're looking at in the fair value gap. All right, so that's exactly what it looks like. So let's assume that these are all buy candles. So let me change that to green, because I know a lot of people have green as their bullish candles. Let's say we have this right here, we also have this right here, and lastly this other candle right here is also a bullish candle, but there is a very open space between. It's just an imbalance, right? Because of how impulsive the movements were, there were imbalances, right? There were inefficiencies in the market, and you can see that sometimes price will come back, even though this is a buy movement. So let's assume there's a sell move, there's a sell candlestick right here, and of course a lot of people would have marked it as an order block, right? So instead of price to act, sometimes instead of price to get to your order block, which is the bullish candle before the buy movement, the bearish candle, the last bearish candle before the impulsive buy movement, you may be waiting for it, but price will just come here, come up, maybe find a pullback from here, come down to this point. So instead of course you'll be waiting for price to come back to this your zone, to this your bearish candlestick right here that influenced this impulsive buy. Price will just snub you, come over to this void that has been formed here. On its way up, it will come, pick a zone, and then take it up from there. So now, even though you know that price is going to buy and you are positioned for price to buy, price is not getting to buy at your zone, which is the order block, which is why it is important for you to know all of these different institutional reference points. And then each pair that you trade, whatever financial instrument that you trade, that you love trading the most, is best you go back and practice and discover which of these, because there are some pairs, or there are some securities that you trade that work better with some institutional reference points. Okay, there are some pairs, if you check them, if you go back and backtest, you see that price is always delivering, the market is always delivering price to only fair value gaps or only mitigation blocks, and then sometimes a few times other blocks. So if you are trading that kind of security, you find out that you'll be missing a lot of trades, even though you know that price is actually maybe going to buy at this point or going to sell at this zone. But then when you try to put in your own figures, when you open your trade execution app and you fill in your numbers, it is not getting to that place. All right, it is not getting to that place. So that is it. And then your favorite order block, of course, you know what an order block is. In a downtrend, it is the last bullish candle before the impulsive sell. If it is in an uptrend, it's the last bearish candle before the impulsive buy. All right, okay? I don't think we really need to go into the order block. Let's look at the rejection block. The rejection block is usually a 3-candle formation, right? Some people also call it an unmitigated wick. This is like when you see a very long candle. This is like when you see, it's a 3-candle formation anyway, just like the fair value gap. It is a 3-candle formation, but it is also rare to see just like the breaker block. Okay, so it is usually a 3-candle formation. Sometimes, let's say in a downtrend, let's say you see something like this, all right, a buy candle, at least 2 of the handles should have the same body size, and then we have like a very pronounced wick, right, of the middle candle, right? So most times price tends to come back to this, even after price has delivered price somewhere else. Most times you see that price comes back to actually take off from this zone, right? To take off from this unmitigated wick right here, which is a rejection block. Okay, so then we have old highs and old lows, places that price has gone to in the this old highs and old lows are quite simple to understand. Other highs and other lows that price has created in the past, price is most likely to come back to it and take off from there. So these things are quite easy to understand. The most important thing is you have to actually test over and over again. Test it on your chart. Test it on your chart. This is the only way you build confidence, so that even when you see it on your chart, even when it hasn't played out, you get to see these things, spot them. Not only your order block, right? Price doesn't really care about your order block. The market movers are going to take price to wherever they feel like is going to be most profitable for them. So it's better that you are aware of these things and you get to key into them early enough. So thank you so much for staying to the end of this video. If this video has given you any sort of value, please give it a thumbs up, subscribe to the YouTube channel to encourage us, so that other people too get to see this kind of videos and it will be helpful for them. If you have any comments, suggestion, anything you'd like to say, or how you approach the market, or even if you know any of these institutional reference points, please put them in the comment section and I'll be sure to get to them when I see them. Thank you again for staying to the end of this video. If you'd like to learn more about mitigation, breaker block, liquidity void, just click on the next video and I'll see you in the next one. Bye bye.